Pension funding and the tax benefits that go with it. Okay, not many people love pensions. They think of them as being an old fuddy-duddy kind of investment. You have to wait till you're 60 or 70 years of age. So you might not be thinking about this if you're in your early 20s. But there's great ways to save tax, so please do consider it. I'm not a pension advisor, I'm not a wealth manager. I'm providing you this information purely from a tax perspective. But let's look at how this could benefit you as an individual or as a company or both. If you're an individual, let's do this first. You don't have a limited company, you're just a normal employed person who has income through PAYE, so normal salary income. Let's say your income is £140,000, which is a fantastic income to have, no doubt. But what's happening here? If you think about the tax bands, you've already gone through the zero rate tax band from 0 to 50,000, from 50 to 100,000 you're at the higher rate of 40. You're getting up to the 45% tax bracket here. But what you've done for £25,000 of this income, you've lost your personal tax allowance. If you refer to another video we've done called the abatement of personal tax allowance, you'll find that you'll see what the implications of that are. But what's happening here? You know, a lot of this money, so £90,000 of this money is sat north of 40% in terms of tax. So how can you control that? One way you could do that, and again, this is not suggesting you invest this amount of money, but it's just trying to give you an indication. If you said, I will invest £40,000 of the money I've got into a pension scheme rather than drawing it as income, that would save you 40% in tax against this here. So you would actually save yourself £16,000 in tax as an individual. Your invested funds are predominantly tax-free, so they're tax-free going in, you get a tax rebate against the income that you've got, and predominantly over the course of the investment term, they're tax-free through the journey in the pension. When you get to retirement, again, we can cover that another time because that's quite complicated, but for now, this is about getting tax breaks at the front end. If you're a company, and again, you've got bags of cash sat in your business, again, let's use the same example of £140,000, you could decide that rather than having to draw the money as an individual and then pay tax on it and then draw it back and claim the tax back, you can just directly fund into a personal pension plan or a self-invested personal pension, SIP as you may well know it, directly from your company. That would be a company-funded contribution for you as an individual. So again, the same logic here. Let's say you put £40,000 into your pension scheme through the company. That would attract 19% corporation tax. So that's going to save you, thick end of £8,000. But the beauty of this is coming pre-tax, whereas all of this is coming post-tax. And a lot of you probably have a structure in your business where you have a low salary, dividends, and then expenses. What you don't want to do is inflate your income purely to pay tax to try and reclaim it. This is probably the most economical way to invest in a pension if you have a company structure. But pretty healthy savings, 16,000 as an individual or 8,000 as a company. But it's even better than that. You can invest in some, or there's another way to do this. You've got something called carry back, carry forward. Now, what's carry back, carry forward mean? If you've done this, or you haven't done this for a number of years, you just drawn your income, merrily spent it and had a good life, that's fine. But now you get to the point where you're thinking it's getting serious. You're not in your 20s, you've gone through your 30s, you're in your 40s now, and all of a sudden you're thinking about what next. You can use up to 3 years unused tax relief from prior years where you haven't funded into a pension. So if you think back and think, well, I'm now going to invest my £40,000 here 3 years on, that's fine, you're using it in the same way I'm talking about, be it as an individual or a corporate, but you've lost these 3 years. So you could actually go back and put up to £120,000 in, plus the £40,000 in this year, and put through £160,000. Now in doing that, if you're a corporate entity that's all of a sudden got a fairly decent slab of cash, you're going to save yourself nearly £32,000 in tax. Great, you've also got the money invested in your name, ready for the future as well, or as an individual, the same logic applies. That's pension funding and the tax breaks.